Okay, so today's class, we're going to talk about investment basics. So when we think about investing, we're going to go through some various topics. The first one we're going to talk about is fundamental investment concepts. And then we'll get into talking about general investment options that you might have available to you. And then we'll also talk about various investment strategies. And then lastly, we'll spend some time talking about asset allocation and how you might invest some of those dollars that you're thinking about saving for various purposes. So we usually start off the class by asking a question, and today's class would be, what does investing mean to you? So as an investor, when we think about that, we like to ask and find out, what is investing? What does investing mean to you? So generally, we find that some people have different opinions of that. Some people may feel that it's like speculating or gambling, where you're taking on high risk, high volatility, and other people might think it's just like a savings, where you're, looking at it long term, kind of methodical effort to save for the future, just putting money away, year after year or month after month. But we kind of look at it from the approach of thinking of it as, maybe it's really a combination of the two of these, a little bit of both, where, you may have actually thought about it, but we like to think of investing as a carefully planned and strategic approach to managing and accumulating money. So managing and accumulating that money really for a specific purpose, okay? So one of the fundamentals when we talk about investing is inflation and the effect of inflation and how that's what kind of impact it's gonna have on the purchasing power of those dollars that you're saving in the future. I'm sure most of you have realized or seen a lot of the effects of inflation in the last 2 years. So just looking at things, what they cost maybe prior to 2020 versus what they cost today. And even for those of you who might be on Social Security already, your Social Security actually inflated this year by 8.7% because of the cost of living adjustment for 2022. So when we think of the effects of inflation and we look at this purchasing power, we look at it from the perspective of using a simple illustration of, let's say that we had $200,000 and we just stuck that $200,000 away somewhere where it wasn't earning interest, kind of stashing it in your mattress type of an effect. So if we look at a simple rate of inflation of just 3%, if we look at that, say over a period of time, we're going to see that after 20 years, that $200,000 would have actually got cut almost in half. And then if we take it out another 20 years, then our purchasing power or those dollars are really only worth about $60,000 versus the $200,000 that they were worth 40 years ago. So, it's not a matter of looking at just your investments from that aspect, but we want to look at it from, what is our real rate of return after inflation for those purposes. So we always want to make sure that we're trying to stay ahead of inflation when we're looking at our investments, because otherwise, if we're saving money and it's just sitting in a checking account, as you can see by this illustration, you're really losing money safely. So let's take a look at this effect of inflation again, but from a different aspect as far as how do we combat that. So kind of the opposite of inflation, we call the effects of compounding. So compounding is where you're investing your money and you're earning interest on that money. And then each and every year, the next period of time, you're also going to earn interest on the interest that you earned the year before. So that's what's really classified as compounding interest. So this is a simple example that we're going to use of somebody investing $5,000 per year. And at the end of each year, we're going to assume that they're getting a 6% rate of return on their money. And then all of their earnings are going to continue to be reinvested, year after year after year. So if we look at this, they actually, over that 30-year period, they would have actually accumulated almost $400,000. So you can see that power of that compounding, because if you really look at over those 30 years, by them investing $5,000 per year, they really only invested a total of $150,000. So that $150,000 actually grew to almost $400,000 because of that compounding effect. So there's another rule that we look at. It's called the rule of 72. So the rule of 72 is a rule that can show you how many years it's going to take to double your money, or how many years there would be needed in order to double the value of that investment. So you just take the number 72, and if you divide that by the rate of return, then it would tell you how many years it's going to take to double in value. So let's say, for example, in our illustration, we were getting a 6% rate of return. So if we took 72 and we divided it by 6, that's going to give us 12 years. So it's going to take us 12 years to double our money based upon that rule. So another example of that might be, well, let's say I wanted to double my money in 8 years. So what rate of return would I need to get if I wanted to double my money in a period of 8 years? So you can again do the same thing. You could take 72 and divide it by the number of years, that 8, and it would give you the number 9, which would be telling you that you would need to get at least a 9% average annual return over those 8 years in order to double your money. So we're also going to talk about the fundamental of time, not necessarily timing the market, but time in the market. So it's a matter of, the sooner you're able to invest, the better off you're going to be. Don't put investing off. So here's an example of 3 people that we're going to talk about. They're each going to invest $3,000 per year. And we're also going to assume that they're getting that 6% annual rate of return. And we're also going to assume that all the money is reinvested, and we're not going to really account for any type of tax consequences at this point. So the first person, they start out at age 20. They're saving $3,000 per year. So they're actually able to accumulate almost $680,000 over that 45-year period. So from age 20 to age 65, they would have accumulated approximately $680,000. So our next person, they kind of procrastinate, and they're going to wait until they're age 35. So in their example, they're only able to accumulate $254,000. And then our last person, they didn't start investing until roughly age 45. So they only had a 20-year time frame for the investing as well as for that compounding. So you can see the dramatic effect of that compounding over that longer period of time of that, investing starting at age 20 versus starting at age 35 or at age 45. But, again, it's never too late to start investing and start catching up. So when we talk about trying to catch up, how would you actually catch up with regard to that? So there's a couple different ways. Let's say I'm 35 and I determined that I need to save $680,000 to reach my goal, or let's say my goal would be for retirement. Then in that case, I would either have to save more than the $3,000 per year, or I would need to get a higher rate of return than 6%. And I could also do a combination of both of those, of getting a higher rate of return and then also saving more on an annual basis. So you don't want to try to get in that scenario or get in that effect of trying to play catch up, because that can be very difficult. So our next fundamental of investing would be talking about identifying goals and time horizons. So for most people, most people are investing for a purpose. They're not just generally investing money just to say that they have investments. So some of those goals and objectives might be things like retirement, saving for a child's education, maybe having a down payment for a home or a new car. And then you might even want to just have financial security. So just knowing that you have the resources if something were to happen, you would have those resources kind of as a backup plan. So the next part of this, or the next aspect, would be looking at the time horizon of your goal. So is your goal shorter term, or is it longer term period? So that means, do I have only, let's say, 4 or 5 years that I'm going to be investing the money for a short period? Let's say maybe to save for that down payment on the house, or do I have a longer period, maybe 30 years or 40 years to save for retirement? So the general concept here is that the longer the time horizon that you have, the more risk you can afford to take, because typically those investment losses can be made up over those longer periods of time. So you definitely want to understand and realize what your actual goals are as you're setting them. How long is it going to take? Those types of aspects. So we'll talk about risk tolerance and how someone might actually go about measuring that, what the purpose of understanding your risk tolerance might be. So it's really kind of the comfort level that you feel that you have when it comes to risk. So what is that comfort level? So there's kind of two aspects of that risk tolerance. The first one is that, your investments should have the ability to absorb losses. And we'll talk a little bit more about that as we get into asset allocation and some of those diversification features. But you want to try to create an investment plan that's going to be able to absorb some losses relevant to your long-term objectives. And then secondly, what is your personal tolerance for risk? And that can generally be described into 3 different categories. Are you a conservative person? Are you more moderate? Or are you more aggressive? So that doesn't necessarily mean that it could be based upon age. That could really be based upon anything. It's really just about how you feel about those investments. So, even if you're 75 or 80 years old and you want to have a lot of money invested in stocks or in equities, that might be considered aggressive for some people, but to you, that may not seem aggressive. That's where you want to be, and that's where you feel comfortable. For other people, they might say, no, I don't want to take that much risk. I don't like seeing my investments go up and down that dramatically. I'm more conservative. Okay. So we always tell people, whatever is going to make you sleep well at night, that's kind of the direction that you want to look at. You don't want to be always worried about this risk that you're inherently taking when you're investing in various different types of assets. So there is a fundamental relationship between risk and return. So typically the lower risk type investments are going to provide you with a lower return. And conversely, if you look at things like common stocks or things like options that have a higher risk, then you're typically going to get a higher return. So when we talk about this risk and return relationship and the trade-off, that's generally, again, over longer periods of time, not over just say a 1-year period or a 2-year period, but maybe looking at it over a 10-year period, somewhere in that aspect. So the other thing we look at relevant to these relationships is this risk and return trade-off between these three factors that we call stability, income, and growth. So these three factors relate more to what is your objective? What's the overall objective of the investment plan? So is my objective to grow my investments? And if that's the case, then I may be considering things that are a little bit more aggressive because I want them to grow. And then secondly, if my objective is for income, I would need to find investments that are going to generate either a high rate of return, such as in interest, or something that's going to generate dividends that are going to provide me with that income. Okay. And then lastly, stability. I'm more concerned about preservation of my investment or preserving that capital. I don't want to be, losing money. So something like stability would be I'm saving money for a year or 2 years to put a down payment on a car. I don't want to take that risk. I want that stability of knowing that that money is going to be there over that 2-year period, because I don't want to invest it in very aggressive stocks and then potentially lose the money that I may have invested, because then I won't have that money to help me reach my goal or objective. So we're going to move into our next topic, our next main topic, which is investment options. So we'll talk about different types of investments. So some of these different types of investments are things like cash alternatives, things like bonds, stocks, other investments, and then funds. So things like mutual funds, exchange traded funds, and we're going to talk more in detail on each one of these topics. So we're not going to talk about a 401k plan or an IRA as an investment because they're really not investments. So a 401k or an IRA is really a tax advantaged vehicle that holds individual investments. So within your 401k or within your IRA, you have various types of investments, such as stocks or bonds or cash or funds. You have those types of investments in those vehicles that are holding them. So in and of themselves, the 401k and the IRA are not really just investments by themselves. So let's talk about our most conservative investment, which would be cash alternatives. So types of investments, they're considered lower risk. They'd be used for short-term goals or objectives, and they're relatively liquid. So some examples of cash alternatives would be things like certificates of deposits, money market deposit accounts that you might get at a bank, money market mutual funds that you would purchase through a mutual fund company, and then US Treasury bills. So US Treasury bills are issued by the federal government, and they're very short-term instruments. So all of these investments again, are things like cash alternatives, or they're classified as the cash alternatives because they're very liquid. So for example, if I need that money right away, I can go to the bank, withdraw the money generally without any problem. So these are some of the advantages and disadvantages of these cash alternatives. So the one advantage is that it's going to provide you with predictable earnings. It's highly liquid, and there's very little risk to the principal. So the disadvantages is again the low returns, because if we need to get a higher rate of return to achieve our goal that might be longer, we don't want to just leave that money sitting in some type of cash investment. And primarily, they may not keep up with inflation. So if you look at what these cash investments were generating, let's say a year ago or two, they were probably well below 1%. Versus today, some of these cash investments that you might get, like a money market, some type of instruments like that, they could be getting close to 5%. So, and the reason for that is due to inflation and the interest rate increase by the Federal Reserve over the last, say, year and a half. So as we move up our scale on the risk and return chart, we're going to talk about bonds. So bonds are really what's classified as a loan. So you're lending your money to a government or to a corporation. So just like as if you were to go get a loan at the bank, these bonds are what are issued by the government or by large corporations that don't typically go to the bank to borrow money. They issue these bonds. The interest is typically paid at regular intervals. So those intervals could be monthly, they could be quarterly, or they could just be annually. So bonds, they can also be traded just like other securities. So these bonds, because they're trading in the open market, they can have a fluctuating value. So these values do fluctuate. And if you had bonds and you held those bonds last year in 2022, you can see that even bonds lost money. So the primary reason for that was because when interest rates rise, the value of bonds tends to go down. So there's an inverse relationship between the value of your bonds and the interest rate. Okay. So conversely, that would be true too as well. So if interest rates were to go down, then the value of bonds would typically go up again. So just something to keep in the back of your mind, knowing that these bonds can trade just like any other securities, and they can be fairly volatile. So these are different types of bonds. There's what are called U.S. government securities. So these U.S. government securities are backed by the full faith and credit of the U.S. government. They're typically have different returns depending upon the time frame that you're buying them. And then there are what are called agency and GSE bonds. So these types of bonds are what are called government agency bonds. So they're not necessarily backed by the full faith and credit of the government, but they are issued by those agencies. So some of those agencies might be things like the mortgage corporation, the mortgage loan corporation, and also the student loan corporation that backs some of these student loans that are out there. And then the third type of bond is what's called a municipal bond. So municipal bonds are issued by states and local governments. They're typically free from federal income tax. So sometimes people use those for that tax-free interest rates that you could potentially get. And then lastly, There are what are called corporate bonds. So corporate bonds are issued by companies. Um, so depending upon the companies issuing them, they have different ratings. So these ratings can go anywhere from AAA all the way down to C type rated bonds. So when you want to purchase potentially corporate bonds or even municipal bonds, you may want to look at the ratings, because the ratings can tell you how much risk might be involved in purchasing those bonds. So with bonds that have a lower credit rating, you should potentially uh, be aware that you should potentially be getting a higher rate of interest than what a bond might be that, let's say, AAA rated. Okay. So the reason for that would be, just like any other person that's borrowing money. Let's say, for example, I go to the bank and I have poor credit. Well, the bank is going to charge me a higher interest rate than if I had, an 800 score on my credit rating. Okay. Uh, so that person that has that 800 credit score or 750 credit score, they're probably going to get a better interest rate to borrow the money than someone that has poor credit, because there's a higher risk there for the bank lending the money. So we'll go through some of the advantages and disadvantages of the bonds. So typically bonds pay a steady stream of income that seems to be very reliable. The income's typically higher than cash alternatives. Typically those interest rates are a little higher. Relatively lower risk compared to other options such as stocks. And there's typically what's classified as a low correlation to the stock market. Okay, so correlation means that how are they moving? Are they moving in the same direction? Are they moving in opposite directions? Various aspects like that. So that's part of the reason people may invest in bonds, is because they're not moving in the same directions as stocks. So some of the disadvantages are that there is a risk of default. So default means that the person that issued these bonds, or let's say the government, the municipality, the corporation, if they were to go into default, then you wouldn't get paid back your principal. The other risk is the fluctuation in the value with regard to interest rates, which we discussed. So as interest rates rise, the value of bonds goes down. And as interest rates go down, the value of bonds typically go up. So what this means is that this lower risk, typically you're going to get lower potential returns than you might get from other types of investments such as stocks. So let's move on, and we're going to start talking about stocks. So stocks represent ownership of a business. So when you purchase stock, you're actually buying into the business. You get to share, you have a percentage of the ownership. You get to share in the profits and the losses of that business. Now, typically with stocks, unlike bonds, stocks may pay a dividend. So the earnings of that company might be shared with the shareholders. And one of the ways they share those earnings is through dividends. And then lastly, you can sell your stocks. You can sell them for a gain or for a loss. So depending upon the price that you paid for them versus the current price when you're selling them, that would determine how much of a gain or a loss that you might have, as well as you might want to be aware of what the tax consequences are of buying and selling those shares of stock. So we're going to talk about different types of stocks. So generally, corporations issue two types of stock, either common stock or preferred stock. So common stockholders, they have more rights. They include the right to vote, but they're last in line to claim any earnings and assets of the company. They can potentially receive dividends, but they receive those dividends primarily at the discretion of the company. You know, are they going to pay dividends? Are they not going to pay dividends? Have they been profitable or not? Things like that. Versus a preferred stock is a little bit different. It's given priority over the common stockholders when it comes to the dividends and the assets. They don't receive all the privileges such as having the right to vote. So there's a little bit less return potential than the common stockholders because there's a little bit lower risk. So some of these common stockholders can benefit from these, you know, payments of dividends, which sometimes could be actually scheduled, or they, you know, they're readily known and available that, yeah, we are going to pay these dividends because that's the type of stock that you had purchased. So stocks also categorized by these market caps. So you can have companies that are considered small cap, which are smaller type companies, mid cap, and then large cap companies. Okay, so depending upon the size of the company, they would be categorized as small size, mid size, or large. And then some other stock terminology that you may want to be aware of. So there are things like stocks that are classified as growth stocks, which are generally characterized by increasing faster than their industry average. So some of those types of stocks you might want to think about are considered to be things like technology. So if you think of technology stocks, those are typically classified as growth stocks. And then there are value stocks that are typically characterized by selling below what their assets might be actually valued at, or what the company's sales are valued at, or their earnings. So they're getting a lower price than what the actual book value might be. And then there are income stocks. So these income stocks are generally higher dividend paying type stocks. They typically fall in the categories of things like maybe utilities or financial companies that are paying dividends, you know, more well-established type industries. And then lastly, there are what are classified as blue chip stocks. So these blue chip stocks, I would think of those as companies that might be in the S&P 500. So the S&P 500 is an index which is comprised of the 500 largest companies in the United States. Okay, so those might be classified as what are called blue chip stocks. And then lastly, there are what are called American depository receipts. So these American depository receipts, they're basically negotiable instruments similar to stocks that represent shares of non-US companies. So investing internationally, there's different rules and regulations about that. So you may be investing in what's called an American depository receipt versus the actual stocks. And sometimes these can pose additional risk, such as currency exchange risk, economic and political risk based upon those countries. So again, something that you might want to be aware of if you're looking to invest internationally. So we'll kind of talk a little bit about the advantages and disadvantages of stocks. So some of the advantages of stocks are that they historically have provided longer term, higher returns. They provide you with ownership rights. So that allows you to share in the profits as well as the losses of the company. So those are some both advantages and disadvantages. They can potentially provide income through dividends, as well as you can also earn based upon the capital appreciation. So the capital appreciation is the difference in the share price that you purchased it at versus the current market share price, which hopefully is higher, which would mean that that's classified as capital appreciation. So the other advantage to stocks is that they're typically pretty simple to buy and sell. You could open up a brokerage account at a various company, and you could place an order to buy and sell XYZ company, or you could buy Microsoft or Tesla. You could buy PPG, hundreds and thousands of different stocks. So some of the disadvantages are that, poor company performance is going to affect the value of those shares as well as the dividends. So let's say you were purchasing a company because you like the dividend and you were needing the dividend to live off of, and all of a sudden the company has poor performance and then they reduce the dividend or cut it altogether. You're not going to be very happy with that because it's not going to meet your objective of providing that income. So stocks are subject to market volatility. Each and every day that the market trades, these stocks change in value. So there is greater risk to your principal because of that market fluctuation, the volatility, things like that. So you want to be aware of that risk, and typically you don't want to be investing in stocks, at least if you're not investing for, I would say, somewhere between a minimum of 3 to 5 years and hopefully 5 years or greater, to kind of reduce that volatility or reduce that risk to the principal. And as I stated, again, they may not be appropriate for short-term investments. So such as the one example that we were talking about, as far as investing for maybe a down payment for a car, probably wouldn't recommend somebody investing in stocks for that type of short-term objective. So we're going to move forward and we're going to talk about some other types of investments. So some of these other types of investments would include things like real estate. So that would be someone that might be investing in, let's say maybe they bought an apartment building and they're renting that out, or they buy, several different homes and they're renting those out. That's considered a real estate investment. Other types of real estate investment would be things that are called a real estate investment trust, or they use the acronym of REIT. So those are very large pooled types of investments where a company goes out, they purchase large commercial buildings such as office buildings or commercial buildings for retail, industry, and they pull those real estate assets together and they sell those shares of this REIT, or this real estate investment trust, to the public, so that you have ownership in various kinds of real estate. So there are other investment options such as stock options. So stock options are generally classified as you're kind of placing a bet on that stock. Is the stock going to go up or is the stock going to go down? So you can kind of place that bet without actually buying the stock. So those are what are called stock options. Commodities. So commodities are things such as gold, silver, sugar, wheat, oil. So those are some examples of commodities, which might be things that people use each and every day, things that are generally used to fight inflation or offset inflation, things like that. And then lastly, another type of investment might be classified as collectibles. So there's different types of collectibles such as coins, stamp collections, as well as art. So fine art could be considered a collection, and even things like automobiles. So if you think about someone like Jay Leno, he has a large car collection that would be considered an asset be considered some type of an investment. So we're going to next talk about mutual funds, which most people, I would believe most people would be somewhat familiar with mutual funds. So mutual funds is really where your money is pooled together with thousands of other investors. The fund invests these dollars according to a stated strategy, which you could find in a booklet from the company or what's called a prospectus. So you own a portion of the securities of the stocks or bonds that are held by these funds. So you get instant diversification within a mutual fund. So that's one of the benefits of purchasing mutual funds, is that you get that instant diversification. You don't have to go out and, let's say, buy 100 different stocks. You could buy one mutual fund that might own 100 different stocks within that one mutual fund. So again, we always tell clients you should always consider the investment objectives, that you're looking at. The fund's investment objectives, so do they match? So, if my objective is to buy a fund that's for growth, long-term growth, then I wouldn't necessarily maybe want to buy a bond fund that's maybe shorter term. I also want to understand what the risks are and the charges and the expenses. So all of these mutual funds charge some type of fee to invest in them, because they're being managed by those companies. They're being professionally managed to make sure that they're meeting their objectives. So a lot of these questions can be answered in what's called the prospectus, which is the booklet describing what the fund is. And you should take time to potentially review that. Make sure you're looking at what these objectives are and making sure that they're meeting your objectives. So there's different types of mutual funds. So the three main categories are what are called money market funds that are very conservative. There's bond funds. So these bond funds go out and they purchase hundreds or thousands of different bonds. They put them into the one mutual fund, and you could purchase the mutual fund and again get that diversification. And then the third main category are what are called stock funds. So these stock mutual funds, they go out and buy different types of stocks. Some of them might be classified as large cap stocks or mid cap stocks or small cap stocks. So for example, if I'm going out into the marketplace and I want to buy a mid cap mutual fund, then that mid-cap mutual fund should basically be holding the majority of those stocks that are classified as mid-cap. And just like as if I wanted to buy a large cap mutual fund of stocks, then that large cap mutual fund of stocks shouldn't really be buying, any small cap or mid-cap type stocks within there. And then if we take a look at the mutual fund industry, they've actually found a way to give you even more diversification through what are called balanced funds. So a balanced fund would be where they're mixing both bonds and stocks. So you could buy one mutual fund and have that diversification between bonds and stocks that you might want. So some of these balanced funds, some might be more aggressive, some might be more conservative, and typically the ones that are considered moderate would typically have about 60% in stock and about 40% in bonds. So again, kind of gives you that instant diversification. And then you can also have funds that are international funds. So these international mutual funds, they go out and they buy international stocks with those investment dollars. So it helps you to get instant diversification, potentially around the world, without just investing in the US. And then there are additional types of funds which are not listed on this chart, but there are funds that are called global funds. So global fund might have 50% in US stocks and 50% in international stocks. And then there are also what are called global balanced funds. So a global balanced fund would have money in all categories, such as US bonds, international bonds, US stocks, and international stocks and international bonds as well. So some of these mutual funds, how they're managed, they're typically classified as either active or passive. So typically with active management is where the fund manager is trying to use his knowledge, his research abilities to buy and sell certain securities in an attempt to try to beat the benchmark that it might be measured against. So let's say a mutual fund has a benchmark of the S&P 500, the 500 largest companies in the United States. Well, this active manager may go out, but he's not going to buy all 500 of those stocks. Maybe he's only going to buy what he believes to be the top 300, so that he's hoping to try to beat the overall index that it's measured against. And then conversely, a passive managed account would be more adherent to an index type fund. So there are funds that are called, like, let's say the XYZ company S&P 500 mutual fund, or the S&P or the XYZ company Dow Jones Industrial Average fund. So these funds, they don't take into consideration much active management. They typically have lower fees because there's less research going on in the portfolio. So that does help relevant to sometimes the performance. So we'll talk about some of the advantages and disadvantages of these mutual funds. So the one advantage is you get that instant diversification. You get professional management, where these professional managers are looking at these accounts day in and day out. You can invest small amounts of money. You don't need large sums of money to invest in mutual funds. And they're typically highly liquid. So you can readily get your money back by either going online if you have access to that, or calling the company and telling them, let's say I have $10,000 in my mutual fund and I need $1,000 for an expense that I have upcoming. I can call them and tell them to send me a check for that $1,000. So some of the disadvantages are that these shares can fluctuate, just like shares of stock or the shares of bonds. They're no different because that's what they're actually investing in. A portion of the funds are typically left in cash for liquidity needs. So there is a portion of these funds that are typically in cash, because if one of the investors calls in and says, I need to redeem some of my money for whatever purpose and I want $2,000. Well, they don't just sell investments to get that. They try to keep some money in cash so that they can avoid selling when the market may be down. So mutual funds are typically considered tax inefficient because they do trade periodically, which could potentially generate capital gains distributions to the shareholders. So even though you're not buying and selling yourself, with inside or internally in the mutual fund, they are buying and selling in there, which can, generate tax consequences for you as the mutual fund holder. And then lastly, so mutual funds do come with fees and expenses. So you want to make sure that you understand what the fees are relevant to the cost of purchasing the mutual funds. So our next investment option we'll touch on are what are called exchange traded funds. So these exchange traded funds are very similar to a mutual fund, except most of these exchange traded funds are based upon an index. So again, kind of referring back to what we had talked about, such as an index of the S&P 500. So, you might find an ETF that's called the XYZ company S&P 500 ETF. So these trade just like stocks. So they can be traded throughout the day versus a mutual fund. So when mutual funds are trading even internally, right? So they're trading internally, but the price for those mutual funds are set at the end of the day when the market closes, versus if you're buying and selling your exchange traded funds, if you go online and you place an order to sell your exchange traded fund at, let's say, 1 o'clock in the afternoon, you're going to get the price for that fund, that exchange traded fund, at 1 o'clock in the afternoon. Whereas conversely, if you call up and you say you want to sell, 1,000 shares of your mutual fund, then you're going to get the price at the end of the day, not at 1 o'clock. So it makes it a simple way to invest in a market segment as well. So a market segment would be similar to, let's say, a specific industry. So let's say I wanted to invest a lot of money into just technology, or into even further down below that, I wanted to invest in semiconductors. So I could find an exchange traded fund that mirrors the semiconductor index, and I can purchase that if I wanted to. Or let's say I wanted to invest in the oil industry. I could invest in an ETF that is classified as, let's say, maybe an energy type company. So these exchange traded funds provide better tax efficiency and lower costs because they're not really trading as often, because they're based on these indexes. So again, when you're purchasing things like these exchange traded funds, you want to be aware of the fund's investment objectives, the risks, the charges, and the expenses. And those can all be found in those booklets that we talked about, which are called prospectuses. So let's switch, and we're going to talk about some investment methods now. How might you be investing your money? So one way is through what's called a strategy called dollar cost averaging. So basically, you're investing the same dollar amount at regular intervals over time. So we're going to give you an example. So our example here is that somebody is investing $300 per month. Okay, so in January, the price per share was $30, and they're going to buy 10 shares. And in February, the price drops to $10, so they're actually able to buy 30 shares. And then in March, the price fluctuates up again to $20, so they're able to buy 15 shares. And then the price fluctuates again down to $15, so they can buy 20 shares. And then in May, the price fluctuates up to $25, so they're going to buy 12 shares of that, let's say, mutual fund. So here, if we look at the average price per share that we bought, right? So we purchased at $30, we purchased at $10, we purchased at 20, we purchased at 15 and 25. So if we take those 5 price points and we divide that by 5, we get $20. However, if we take the total amount of money that we invested over that 5-month period, which is $1,500, and we divide that by the total number of shares that we bought, which is 87, we see that our average cost per share was actually $17.24. So you can see this dollar cost averaging actually helps you to buy more shares when the prices are lower, and you're buying fewer shares when the price is high. So many of you are probably doing dollar cost averaging. So if you're invested in a 401k plan and every pay period money comes out of your check to go into your pay, then each and every month you're adding similar dollar amounts and buying various numbers of shares. So you're doing dollar cost averaging, even though you may not know you're doing it. So other ways of looking at dollar cost averaging would be that, let's say I had a large sum of money. Let's say I had $100,000 and I wanted to invest it. So instead of me investing the $100,000 all at one time, I might say, well, I'm going to take $10,000 and I'm going to invest $10,000 per month over the next 10 months. This way I might be able to take advantage of some market fluctuations if I believe that the market might be going down. Okay, so let's move on, and we're going to talk about asset allocation, our fourth major topic. So here, diversification is important because it involves to trying to divide your investment dollars among those broad asset classes that we talked about. So dividing those investment dollars amongst things like cash and bonds and stocks and international investments. So diversifying those, which potentially tries to help you to reduce the risk. So when you're considering this asset allocation, the factors that you want to consider are, again, your risk tolerance. So how much risk are you willing to take? What time frame do I have? So again, typically the longer time frame that I have, I should be able to afford to take a little bit more risk. What is my personal financial situation? What is my goals? What are my objectives? And then lastly, what are my liquidity needs? So I want to make sure that, if I have a major liquidity event, I want to make sure that I have resources available for that, and that not all of my money is tied up into something that might take me a longer period of time to get back. So a good example of that would be, let's say I bought an apartment building, and I own it myself, not through one of these other companies, but I own it individually. So if I were to try to go and sell that apartment building, it's probably going to take me longer than a day or two to sell that. Versus if I owned a stock or a bond, I can typically sell that in the same day. So what are my liquidity needs? So we'll take a look at a couple of different examples of asset allocation. So these are very simple examples. So the first one would be considered a conservative asset allocation, where you might have 50% in bonds, 25% in cash, and 25% in stocks. So relatively conservative. The main focus here is trying to preserve principal. The second asset allocation model might be considered moderate. So here you would have roughly 50% in stocks, 40% in bonds, and 10% in cash type alternatives. So a little bit more maybe predictable income with some potential growth, but again, more of a moderate type risk scale. And then an example of an aggressive portfolio where you might have 75% in stock, 15% in bonds, and 10% in cash. And there are, various different types of asset allocation models, but these are just some simple examples. So you have a general idea as far as this diversification. So that somewhat concludes our class for today. I just want to touch on what the role of a financial professional might be if you were to seek out one. It's really to try to help you to determine your investment goals, the timeliness of the goals, and trying to determine what your risk tolerance is. Their goal and their role should be to try to create an asset allocation model to meet your objectives. They should be able to help you select specific investments in there, and then most importantly, be able to manage the portfolio, monitor it, and modify it if your goals and objectives were to happen to change. So again, seeking out the assistance of a professional is very important. Not unlike someone that would seek out their professional person that's even going to fix your car, right? So it's very complicated to fix your car, as well as it might be more complicated to look at investment and different strategies, looking at all the different tools that a professional might have to, access to versus what an individual investor might have. So with that, I want to thank you for your participation in today's class.